What if I told you that one of the biggest financial institutions in the world has just locked the door on you? What if that door, the one you've been trying to walk through for years, leads to the silver market, a market that has been your ticket to financial safety in times of economic turmoil? You've heard the stories, seen the trends, and maybe you've even taken action yourself. But what if everything you knew is about to change? This isn't just another market shift. This is a calculated move. A move that could have massive consequences for millions of retail investors. And you, yes, you, could be left on the other side of that door, looking in. Stay with us, because the story you're about to hear is only beginning. You won't want to miss it. Silver has always held a special place in the world of investments. For centuries, it has been considered a store of value, a safe haven in times of crisis. But in recent years, something unusual began to happen. Retail investors, ordinary people like you and me, started taking a deeper interest in silver. It wasn't just for jewelry or industrial use anymore. It was seen as a way to protect wealth in an unpredictable world. The rebirth of silver in the modern era. In the wake of the global financial crash in 2008, silver, much like gold, began to shine again. However, while gold often stole the spotlight, silver quietly surged in popularity, attracting the attention of retail investors. This group, often overlooked by larger financial institutions, found silver to be an accessible and affordable hedge against the rising cost of living, inflation, and the uncertain economic landscape. It became an attractive alternative to stocks, real estate, and bonds. Unlike the volatile stock market or the erratic nature of crypto, silver appeared to be a tangible asset with enduring value. As central banks pumped money into the global economy, silver's value seemed to grow steadily. It was a tangible resource that could not be easily manipulated in the way fiat currency or paper assets could. But that's when something unexpected started happening. The surge in retail interest. The rise of online trading platforms and investment apps in the last decade completely changed the landscape for individual investors. Retail investors, who once had limited access to the precious metals market, suddenly had the ability to purchase silver with a few clicks. Apps like Robinhood, eToro, and various silver bullion dealers opened the floodgates to a new generation of investors eager to get their hands on the precious metal. The appeal was clear. With silver priced lower than gold, it was perceived as a more accessible entry point for those looking to diversify their portfolios. Investors could buy physical silver coins, bars, or even silver-backed financial products like ETFs. These platforms allowed them to build substantial positions in the market, something that, in the past, would have been nearly impossible without significant capital. The appeal of silver in uncertain times. The world's economic instability only fueled the demand for silver. Central banks' monetary policies, such as low interest rates and money printing, have led to inflation fears. Retail investors, looking for a way to shield their wealth, increasingly turned to silver. Additionally, silver's role in the industrial sector, specifically in technology, solar panels, and electronics, added another layer to its appeal. Silver wasn't just a store of value. It was an essential part of modern manufacturing and technology. During periods of high inflation, retail investors viewed silver as a safe haven, one that could potentially outperform other traditional assets. The demand for silver, particularly physical silver, began to rise, driving its price upward. It seemed as though the precious metal was in the midst of a comeback, one that could last for decades. Retail investors saw this as their opportunity to get in on the ground floor. JPMorgan's role in the silver market. JPMorgan, one of the largest financial institutions in the world, has always had a significant presence in the precious metals market. Their involvement with silver dates back decades. The bank, with its extensive trading capabilities, has dominated silver futures markets, controlling vast amounts of silver in the form of paper contracts and physical metal. But over time, something began to shift. As retail investors poured into the market, JPMorgan, along with other large institutions, began to realize the growing influence of these small-time investors. What once was a market dominated by institutional investors was now becoming increasingly crowded with retail players. And JPMorgan, always ahead of the curve, began to take action to protect its interests in this shifting market. The threat of retail investors. Retail investors, while often dismissed by large financial institutions, were starting to exert significant pressure on silver prices. Through online communities, especially during events like the 2021 Silver Squeeze, these investors were able to rally together and drive up silver prices, at times putting institutions like JPMorgan at risk of losing control over the market. The surge in retail interest created volatility, something the institutions weren't willing to tolerate. So, the question arises, what happens when retail investors start to challenge the power of institutions like JPMorgan? What happens when they disrupt the delicate balance of the silver market? The answer is simple. JPMorgan, with its vast resources and influence, wasn't about to let this happen. And in the next parts of this story, we will explore exactly how JPMorgan responded, and what that means for the future of silver and the retail investors who've bet on it. JPMorgan Chase is not just a bank. It's an institution that has long held the reins of global finance. Over the decades, its influence has stretched across various markets, but none more quietly powerful than the silver market. The rise of retail investors, individuals looking to buy physical silver or trade silver-backed financial products, has posed a new challenge to this colossal institution's control. But how exactly does JPMorgan control such a significant portion of silver, and why does this matter for retail investors? A silent power over silver markets. To understand the depth of JPMorgan's involvement in silver, we must first look at how the silver market operates. The silver market isn't just about buying bars and coins. It's a complex web of physical assets, derivatives, and futures contracts. While gold often dominates the precious metals conversation, silver, with its lower price point, has quietly become the metal of choice for individual investors looking to hedge against inflation or diversify their portfolios. JPMorgan, as one of the largest financial institutions globally, has its hands deep in these markets. For years, the bank has been one of the largest players in the silver futures market, a marketplace where silver is bought and sold on paper rather than in physical form. Through their control over these futures contracts, JPMorgan has a powerful influence on the price of silver, dictating market movements and liquidity. The problem arises when we consider the growing number of retail investors entering this space. In a market where large institutions have long controlled the flow of assets, retail investors have historically been sidelined. But thanks to platforms like Robinhood and the rise of online bullion dealers, retail investors have increasingly been able to buy and trade silver, often in large quantities. This shift has caught the attention of institutions, who now find themselves at a crossroads. How do they maintain control in a market that is rapidly being democratized? The retail investor's threat to the status quo. For retail investors, silver offers an attractive alternative to more volatile investment options like stocks and cryptocurrencies. Unlike digital assets or real estate, silver is a tangible asset, one that is seen as a safe store of value in times of economic uncertainty. And with silver trading at a fraction of the price of gold, it presents an accessible option for smaller investors looking to safeguard their wealth. But for JPMorgan and other institutional players, retail investors entering this space represent a significant disruption. Institutions thrive on market liquidity, the ability to buy and sell assets quickly without moving the price too dramatically. Retail investors, who often operate in smaller quantities but with increasing enthusiasm, can create short-term volatility in the market. This volatility could pose a risk to institutional strategies built around a more predictable market. Moreover, with more and more individuals turning to silver as a safe haven, these large institutions may feel the pressure to assert their dominance over the market once again. The most telling example of this tension emerged during the infamous Silver Squeeze of 2021. Retail investors, largely coordinated through online communities like Reddit's Wall Street Bets, began buying up massive quantities of physical silver and silver-backed ETFs. While silver's price spiked for a short time, institutions like JPMorgan, with their significant market power, were able to regain control. This brief moment of rebellion by retail investors was quickly quelled, revealing the immense sway that financial giants still hold in precious metals markets. JPMorgan's countermeasures, barriers to entry. JPMorgan, fully aware of the rising retail interest in silver, began taking steps to protect its position. These steps were subtle yet effective, designed to steer retail investors away from the metal that they had come to view as a safeguard against inflation. The most significant move by JPMorgan was the subtle shift in access to silver futures contracts, the very market that retail investors had begun to enter. By restricting the liquidity of silver contracts, JPMorgan made it more difficult for individual investors to access the silver futures market. This move was a strategic attempt to create a barrier to entry, effectively making it harder for smaller players to manipulate the market or drive prices higher. In addition, the bank increased its position in the physical silver market, cornering a larger share of the metal and further limiting access for retail investors. But the effects of these moves were not just felt in the futures markets. Retail investors seeking to buy physical silver also encountered new challenges. The increasing demand for silver, fueled by retail investors, led to a shortage in the market. Coins and bars were suddenly more expensive, with dealers often charging premiums well above the spot price of silver. This shortage, while not entirely orchestrated by JPMorgan, was exacerbated by the bank's own actions to increase its own stockpile of silver. JPMorgan's dominance also led to the price fluctuations in the silver market that kept many retail investors on edge. As the bank's actions created artificial supply shortages, the price of silver became more volatile. This volatility hurt retail investors, who were often left holding positions during periods of high price swings. A market designed for institutional control, JPMorgan's efforts to restrict retail access to silver weren't just about protecting its own position. They were about maintaining control of the entire silver market. In an environment where institutional investors like JPMorgan dominate, the market is less about the true supply and demand of the metal and more about the ability of these institutions to manipulate pricing. By keeping the silver market inaccessible to the masses, JPMorgan ensured that it could continue to move the price of silver at will. This control over the silver market isn't limited to just JPMorgan. Other major players, like Goldman Sachs and HSBC, have similar positions in the market with their own trading strategies designed to keep prices within a range that benefits their larger portfolios. For retail investors, this means they are often left at the mercy of these institutions, unable to move the market or influence silver prices in the way they once believed possible. The implications for retail investors. JPMorgan's market dominance has created a significant barrier for retail investors who once believed they could buy silver and sit back as it protected their wealth. For these smaller players, the silver market is no longer an open space for financial opportunity. Instead, it is becoming increasingly harder to access, with institutional players like JPMorgan quietly tightening their grip on the metal. Retail investors are left with fewer options, unable to participate in a market that they once believed would provide them with a safe haven. The growing power of JPMorgan in silver is a clear signal that the financial system is not designed to allow small players to thrive. Instead, it's an arena where only the largest institutions can hold sway, and retail investors must navigate a market that's becoming increasingly less accessible to them. In any market, the balance of power is crucial. When a few players dominate the game, the rules shift and the risks increase, not just for those in the market, but for the entire financial ecosystem. JPMorgan's dominance over the silver market is not just a matter of corporate power. It has far-reaching consequences that could ripple through global markets and economies. In this section, we will explore the strategic and economic risks of such concentrated control and what it means for retail investors, industries, and the broader financial world. The consolidation of power in precious metals. The silver market has always been somewhat opaque. Unlike stocks or bonds, silver is a tangible asset that doesn't always reflect its true value in the marketplace. Its price is often influenced by multiple factors: industrial demand, investment interest, geopolitical events, and even market sentiment. But when a single institution, like JPMorgan, holds such a large share of the market, the forces of supply and demand no longer drive price movements in the way they should. Instead, institutional strategies dictate the rhythm of the market, manipulating the flow of assets and distorting true market value. JPMorgan's control over the silver market is not a new phenomenon. The bank has been involved in the precious metals space for decades, amassing large positions in both physical silver and silver-backed financial products. Their ability to control a significant portion of silver's supply has allowed them to manage silver's price with relative ease. This concentration of power, however, poses a strategic risk not just for investors, but for the integrity of the market itself. When one or two institutions have the ability to move prices at will, they can create artificial market conditions. This has been witnessed in other commodities markets, such as oil and wheat, where large players can manipulate supply and demand to suit their objectives. If JPMorgan chooses to adjust its silver holdings, it can affect global silver prices in ways that wouldn't happen in a truly open market. Retail investors, who often rely on predictable market behavior, are left at the mercy of these larger institutions. The unintended consequences for global markets. JPMorgan's dominance in silver doesn't just pose a risk for retail investors. It could have a ripple effect across the global economy. Silver is an essential industrial metal, widely used in electronics, solar panels, medical devices, and various other technologies. The increasing reliance on silver in green energy initiatives and technology makes its price fluctuations more than just an inconvenience. They can disrupt entire industries. Take the solar energy sector, for example. Silver is used in photovoltaic cells, which are the heart of solar panels. As demand for clean energy continues to rise, so too does the need for silver. If JPMorgan and other institutional players begin to tighten their grip on silver, the cost of this crucial metal could increase. This would raise production costs for solar panels, leading to higher prices for consumers and making it harder for businesses to adopt renewable energy technologies at scale. Similarly, the electronics industry, which uses silver in everything from smartphones to computers, could face disruptions in supply. A higher silver price, manipulated by institutional traders, could lead to higher costs for tech companies, further driving up consumer prices. In a world where innovation is increasingly driven by technology, any increase in the cost of silver could stall progress across multiple industries. The threat of market manipulation. Market manipulation is not just a theoretical risk, it has already happened. JPMorgan has faced multiple legal challenges related to its involvement in manipulating precious metals markets. In 2020, the bank agreed to pay a massive settlement after facing allegations of manipulating the gold and silver markets through a practice known as spoofing. This involves placing fake orders to influence market prices and then canceling them before they're executed. While JPMorgan denied any wrongdoing in the case, the settlement underscored the extent to which large institutions can manipulate markets to their advantage. The issue of market manipulation is especially concerning for retail investors. When large institutions like JPMorgan have the ability to move prices at will, they create a market where smaller players cannot compete. The lack of transparency makes it difficult for individual investors to make informed decisions. In the case of silver, retail investors who have turned to the metal as a safe haven could find themselves on the losing side, with their investments manipulated by forces beyond their control. Market manipulation is a risk not only for individual investors, but also for the broader financial system. When trust in the integrity of a market is compromised, it can lead to wider instability. Investors may become wary of participating in markets where prices aren't driven by genuine supply and demand, but by the whims of a few powerful players. This undermines the foundational principles of free market capitalism, where competition and fairness are supposed to reign supreme. The regulatory implications. As JPMorgan continues to dominate the silver market, it could eventually draw the attention of regulators. The question of whether such concentrated control over a commodity violates antitrust laws or creates an unfair market could soon come to the forefront. Governments and regulatory bodies, especially in the U.S., have historically been wary of institutions that hold too much power in a given sector. While the silver market is far from the only one affected by this kind of consolidation, the increasing concentration of silver holdings in the hands of a few players could raise alarms. A regulatory crackdown on JPMorgan's activities in silver could lead to significant market upheaval. It's possible that authorities might impose restrictions on their ability to trade or even break up some of their market positions. Such actions could create uncertainty and volatility in the silver market, impacting not just institutional investors, but retail investors as well. The very fact that regulators are starting to scrutinize JPMorgan's involvement in the silver market indicates that the risks of market manipulation are real, and they are growing. Strategic risks for retail investors. For retail investors, the growing dominance of institutions like JPMorgan in the silver market represents a significant risk. These investors, who once saw silver as a way to diversify their portfolios and protect their wealth, may now find themselves boxed out of the market entirely. The increasing difficulty in accessing physical silver, coupled with the volatility caused by institutional control, means that these investors face greater uncertainty than ever before. Moreover, the growing concentration of silver in the hands of a few powerful players could lead to artificially inflated prices. Retail investors may find themselves paying more for silver than it is truly worth, ultimately hurting their investment returns. In the worst-case scenario, the manipulation of silver prices by large institutions could lead to a sudden crash, leaving retail investors with substantial losses. The long-term economic outlook. The rise of institutional power in the silver market is a warning sign for the broader financial landscape. It signals that markets, once thought to be driven by the forces of supply and demand, are becoming increasingly influenced by the strategies of a few powerful institutions. This shift toward market consolidation could have far-reaching consequences for global economic stability. The future of silver, and its role as a safe haven asset, is now uncertain. As institutional control over the metal increases, its value may no longer reflect its true market demand. For retail investors, the long-term outlook is murky at best. Those who once viewed silver as a reliable store of value may find that it is no longer as accessible or as stable as it once seemed. As we move forward, the silver market will be one to watch closely. The concentration of power in the hands of a few could spell trouble for investors, industries, and the global economy. Only time will tell if silver can retain its role as a hedge against economic uncertainty, or if it will become just another tool for institutional manipulation. Silver is often thought of as the quiet sibling of gold. While gold captures the spotlight as the ultimate store of wealth, silver has quietly carved out a crucial niche in both financial markets and industrial applications. But as silver becomes an increasingly controlled and manipulated commodity, its role in the global economy could face dramatic shifts. This part of the story explores the broader implications of silver's growing dominance, not just as a financial asset, but as a critical industrial resource. Silver, a precious metal with broader economic implications. Silver is not just a financial asset. Unlike gold, which is primarily seen as a store of value, silver has significant industrial applications that tie it closely to the global economy. It is used in everything from electronics to solar panels, medicine to automotive industries. Its conductivity and durability make it an essential material in the modern world. In fact, nearly 50% of the world's annual silver demand is driven by industrial use. This is why silver has often been referred to as the industrial metal with the precious metals price tag. As demand for silver grows in the tech and renewable energy sectors, the metal has evolved from a traditional safe haven asset to a crucial component in the global supply chain. Solar panels, which rely on silver for their photovoltaic cells, are seen as a cornerstone of the green energy revolution. As the world shifts toward more sustainable energy solutions, the need for silver is expected to increase, making its role in the global economy even more important. The coming market conundrum. But as silver becomes increasingly scarce due to growing industrial demand and the concentration of power in the hands of a few large institutions like JPMorgan, the metal's value could become more volatile, complicating its role in the global economy. What happens when a critical resource, used in vital industries like clean energy and electronics, becomes difficult to access due to the manipulation of supply and demand? The challenges facing the silver market could escalate into a full-blown market conundrum. On one hand, industries that rely on silver will face higher costs, which could lead to increased prices for consumers and manufacturers. In an economy already dealing with inflationary pressures and supply chain disruptions, higher silver costs could trigger a ripple effect across the global economy. The automotive industry, renewable energy projects, and the technology sector, each of which depends heavily on silver, could see significant price increases, leading to inflationary pressure across various markets. On the other hand, The manipulation of silver prices by institutional players like JPMorgan could lead to an artificial shortage, inflating prices beyond what is sustainable for both investors and industries. This would create a scenario where silver, once seen as an affordable asset or commodity, becomes a financial tool out of reach for many, further excluding retail investors from the market. A perfect storm for investors. For individual investors, the coming challenges in the silver market signal a potentially perfect storm. Rising demand, coupled with limited access to silver due to institutional manipulation, could lead to extreme price volatility. Investors who have turned to silver as a hedge against inflation and market instability could find themselves stuck in a market that behaves unpredictably. In a perfect storm scenario, the silver market would experience sudden, unpredictable fluctuations in price as a result of speculative actions, both by institutional players and by investors trying to navigate the supply and demand imbalance. Retail investors, already facing barriers to entry, would find themselves increasingly vulnerable to market manipulation, unable to predict when the next big price swing will occur. For those relying on silver as a long-term investment or a safe haven asset, the increasing volatility could make silver a less attractive option. As prices spike and crash unpredictably, silver may no longer serve the role of a stable investment vehicle. For younger investors who have only recently begun to explore the world of precious metals, this unpredictability could lead to financial losses, further discouraging entry into the silver market. Silver's evolving role in global economic shifts. Silver's growing significance as a core material in renewable energy technologies and electronics is undeniable. But it is exactly this increased demand that poses a potential challenge in the near future. As economies transition toward green energy and the demand for silver in solar panels, electric vehicles, and electronics rises, the price of silver could be driven upwards, potentially pricing out key industries that depend on it. In the context of the green energy transition, silver plays a pivotal role in the production of solar panels, batteries, and other critical components in renewable energy infrastructure. With global goals to reduce carbon emissions, the push for solar energy is at an all-time high. However, as JPMorgan and other large institutions lock down the silver supply, these green initiatives may face increased costs, slowing progress in the renewable energy sector. The irony is stark. The metal that could help power the green energy future could become one of the biggest obstacles in its path. Rising silver prices could stunt the development of technologies that are essential for a sustainable future. And as large institutional players manipulate this critical resource, the balance between economic development, environmental sustainability, and market fairness becomes increasingly fragile. The strategic implications for investors and entrepreneurs. For business leaders and entrepreneurs, the challenges in the silver market signal the need for a broader understanding of market dynamics and risk management. As the global market becomes more influenced by the control of a few powerful institutions, it becomes imperative for entrepreneurs to consider alternative investment strategies. Relying too heavily on silver, whether as a financial asset or as a raw material for their businesses, could expose them to significant risk in an unpredictable market. Furthermore, the increasing volatility in silver could force businesses to reconsider their production models. For industries heavily reliant on silver, this may mean exploring alternative materials or investing in innovations that reduce their dependence on the metal. In the case of the solar energy sector, for example, the search for more affordable and scalable alternatives to silver could intensify. Business leaders who are ahead of this curve will be better positioned to mitigate risk and capitalize on emerging opportunities. Entrepreneurs should also be aware of the shifting dynamics in the financial markets. The increasing concentration of power in the hands of a few financial giants like JPMorgan requires a reevaluation of traditional investment strategies. Those who want to survive and thrive in this evolving landscape must be agile, proactive, and aware of the underlying forces shaping the markets. What does this mean for the future of silver? The future of silver seems uncertain, as growing demand from both industry and retail investors conflicts with the concentration of power in the hands of a few institutions. For the global economy, silver's rising price and the manipulation of its availability could create significant challenges for industries that rely on it. particularly in the context of the green energy transition. As this perfect storm looms on the horizon, investors, industries, and governments will need to carefully navigate the shifting tides of the silver market. The bigger picture, is this a glimpse of a larger trend? The story of silver is not just about a single commodity. It's a microcosm of the broader trends shaping the global economy. The increasing consolidation of power in financial markets, the rise of institutional dominance, and the shift toward an unpredictable market are all part of a larger narrative that affects us all. Silver's role in this story will serve as a bellwether for future developments in global finance, and it raises important questions about the future of wealth, investment, and economic fairness. As we look ahead, the silver market will likely be a key indicator of how financial markets evolve in the 21st century. And what happens in this market could have profound implications for investors, entrepreneurs, and the global economy as a whole. As we close in on the final chapter of this unfolding saga, the reality of the silver market's transformation becomes undeniable. The forces at play, ranging from institutional dominance and regulatory scrutiny to industrial demand and market volatility, are reshaping the landscape in ways that will require new strategies, adaptability, and foresight. In this part of the story, we look at how investors, businesses, and entrepreneurs can prepare for the next phase of the silver market, one where the rules are no longer as predictable as they once were. Adapting to market shifts, what investors must do. The first and most crucial step for investors looking to navigate the evolving silver market is recognizing that traditional investment strategies may no longer be enough. For years, silver has been viewed as a safe haven asset, a tangible store of value in times of economic uncertainty. But as silver's accessibility becomes increasingly limited and its price becomes more volatile, investors must rethink their approach. For retail investors, the days of simply purchasing silver bullion or coins and waiting for long-term growth may be coming to an end. The silver market, controlled by powerful institutional players like JPMorgan, now requires a more sophisticated strategy. This doesn't mean giving up on silver altogether, but it does mean diversifying investment strategies to hedge against the risks of institutional manipulation and market volatility. One of the most effective ways for investors to adapt is by diversifying into other precious metals or alternative assets. Gold, for example, while more expensive, offers similar characteristics as a store of value and a hedge against inflation. Beyond precious metals, other assets, such as real estate, cryptocurrencies, and even green energy investments, could provide stability as the silver market continues to fluctuate. Another strategy that investors may need to adopt is a more dynamic approach to market timing. Silver's price swings could become more pronounced, requiring active monitoring and potentially quicker buy and sell decisions. For retail investors, this means a shift from long-term holding to more tactical investing, where timing and knowledge of market movements become critical to success. Strategic risk management for businesses. For businesses that rely on silver as an essential input, particularly in the tech, automotive, and renewable energy sectors, the stakes have never been higher. The risk of supply shortages, rising prices, and unpredictable price fluctuations is real. Companies that do not have contingency plans in place may face increasing production costs, which could erode profit margins and disrupt supply chains. Businesses must now factor in the volatility of silver prices into their long-term planning. For example, companies in the solar industry, which rely heavily on silver for photovoltaic cells, could consider long-term silver contracts or hedge against price increases using financial instruments. While this won't eliminate the risks, it could help stabilize costs and provide some protection against market manipulation. In industries where silver is a critical component, it may also be necessary to explore alternatives. The push for greener energy solutions is already driving research into silver substitutes in solar panels, batteries, and electronics. Companies that can innovate in this area may have a significant competitive advantage, allowing them to avoid the cost pressures that come with rising silver prices. Strategic partnerships will also become more important in the coming years. Businesses that depend on silver should collaborate with silver producers, manufacturers, and even other industries to secure reliable supply chains. As silver becomes harder to access, long-term relationships and secured contracts will be key to ensuring steady production. The role of regulatory oversight. Will governments intervene? As silver continues to experience heightened volatility, the possibility of government intervention becomes more likely. Financial regulators, who have already begun to scrutinize JPMorgan's actions in the silver market, may impose new rules to level the playing field and ensure that retail investors are not left behind in a market controlled by institutional giants. The question remains, will regulators step in to prevent further market manipulation, or will they continue to allow institutions like JPMorgan to operate largely unchecked? The outcome of this will significantly impact both retail investors and industries relying on silver. If regulatory authorities take action to open up the market and ensure greater transparency, it could lead to a more balanced playing field. This, however, would require a significant shift in policy and regulatory action, particularly in markets where institutions have enjoyed decades of dominance. Governments around the world will also need to consider the implications of rising silver prices on their green energy ambitions. If silver prices continue to rise due to market manipulation, it could undermine the financial viability of renewable energy projects. In this scenario, governments may need to step in to ensure that silver remains accessible for critical green technologies, potentially through subsidies, price controls, or even increased domestic production. The rise of digital assets. Could they replace silver as a safe haven? The increasing instability in the silver market, coupled with its rising prices and the dominance of institutional players, could lead some investors to rethink the very notion of precious metals as the ultimate store of value. Cryptocurrencies, particularly Bitcoin, have already emerged as a potential alternative to traditional stores of value like gold and silver. Unlike silver, cryptocurrencies are not directly subject to the control of large financial institutions. With Bitcoin's decentralized nature and its ability to act as a hedge against inflation, some investors are already shifting their focus to digital assets as a safer and more accessible alternative. This shift could further erode silver's role as a safe haven, as investors seek assets that are less prone to manipulation by powerful institutions. However, digital assets also carry their own risks. The volatility of cryptocurrencies is well documented, and while they offer new opportunities for diversification, they do not come without their own set of challenges. For many investors, the future will likely involve a combination of physical and digital assets, balancing the security of tangible resources with the flexibility of decentralized digital currencies. Adapting to the future, navigating the evolving financial landscape. The evolving silver market is a clear signal that the financial landscape is changing. For retail investors, entrepreneurs, and business leaders, the key to survival lies in adaptability and a willingness to diversify. Those who remain fixed in their beliefs about silver as a safe haven asset may find themselves caught off guard by the market's shifting dynamics. The silver market's transformation is part of a broader trend in global finance, where the concentration of power in the hands of a few institutions is becoming the norm. In this new environment, financial agility is paramount. Entrepreneurs must learn to read market signals, identify emerging opportunities, and adopt strategies that allow them to pivot quickly in response to unforeseen challenges. Looking ahead, the uncertainty of silver's future. The future of silver is uncertain, but one thing is clear. The silver market is no longer what it once was. As institutional dominance grows and retail investors are increasingly pushed out, the metal's role as a reliable hedge against economic uncertainty may be in jeopardy. Rising industrial demand, volatile price movements, and the potential for market manipulation all point to a future where silver is no longer the predictable, stable asset it once was. For investors, businesses, and governments, the time to prepare for the next phase of the silver market is now. The landscape is shifting, and those who are ready to adapt to the new reality will be best positioned to thrive in an increasingly unpredictable financial world.